Hey everyone, this proven free your cash budgeting strategy is a simple yet super effective way to budget. And this strategy has actually helped my clients save an additional $8,000 per year on average. So if you're someone that's struggling to keep the money that you bring home, then keep watching this video. In fact, I'm going to show you an app that that I use and that my clients use that helps them keep track of their weekly cash flow spending. Okay, so there's no heavy expense tracking involved. There's actually just one number they need to focus on, and that's it. Okay, so when it comes to financial planning, anytime I'm helping a client or a student invest, one of the first things I ask them to do is to look at their numbers. Okay, so for example, with a one-on-one client, when I do develop a financial plan for them, okay, the first thing I ask them to do is, the first thing I do for them is to look at what they make, or what they spend, what they own, and what they owe. Because in order for anyone to meet their financial goals, whether it's to pay off debt, save more money, invest money, money needs to be set aside for it. And a lot of times people just lie to themselves when it comes to how much money they spend, but for sure how much money they save. Okay, they try to lie to me, but then I look at their numbers and then I go, you say you're saving like $800 a month. I look at your savings account and you're only lying to yourself. Okay, so this is why having someone like a professional like myself looking at your budget and cash flow plan, creating a plan like this is super helpful, and it's a great way to stay organized. And again, this is a strategy that it's super effective and a very easy way to keep track of your budget, while making sure you're setting aside, prioritizing your savings and your investments. Okay, so again, money needs to be set aside for it and for your goals. If you're not doing it, you're not saving, nothing's going to happen. Likewise, if your savings is sporadic and random and you don't know how much you're saving, and you're just putting aside whatever is left at the end of each month, you don't know where that's going to take you, and you risk not having enough money later on, specifically when you retired. And that's a really crappy thing to happen, because a lot of time has passed, and last thing you want is to run out of money when you stop working. So in this example, I'm looking at a client's financials. So I changed the name for privacy purposes. So I'm going to help her free up some money each month. Okay, so the first thing I asked her to do was input her income, her assets, the debts that she has, and all of her expenses. Okay, and when it comes to her variable spending, like her day-to-day spending, I'm not asking to look at her credit card statements and line by line items. I'm just asking her, hey, give me an estimate of what you are spending roughly. And the reason why it's an estimate, because at the end of the day, it really doesn't matter what you've been spending your money on previously. Going forward, this is a new way for her to keep track of her spending. Again, there's just one number she needs to be focused on, and everything else will be automatically set aside for her when it comes to savings and investments. So if she entered her numbers, and if I were to just leave it, okay, this is what I see. I see that there's about $1,000 that's not being accounted for. Okay, so monthly money found. Okay, so she's saving $3,000 a year towards her RSP. So right before the deadline, she makes a lump sum investment, throws it into her RSPs, and that's in addition. This does not include what she gets at work. She has a group RSP, but that's taken out of her paycheck. And then she says she takes out $200 and she puts it towards her TFSA. Okay, and then whatever money is left, it goes into her savings and her checkings account, and she just lets that accumulate. Okay, so at this rate, she says she's spending $2,000 a month. $2,000 a month is quite a bit for a person to spend on, miscellaneous items, right? So if we're to bring it down to just like say $390 a week, right? So $390 a week, this is the spendable. Okay, it's like an allowance. If I were to give you $390 a week, you could spend it on whatever you want. Okay, I don't care if you're going out to eat at the keg once a week, you can go to eat at McDonald's every day, you can buy like a shirt every week, it doesn't matter, right? Just don't go over this amount. Okay, this is for your variable expenses, and they're called variable expenses for a reason because they vary. Okay, and I always say, as unless you live an incredibly boring life, your expenses, your day-to-day spending, your variable expenses are going to change. And even if you do live a very incredibly boring life, prices change. Okay, prices go up, cost of gas, the cost of toilet paper, all these things fluctuate. So your variable spending is not going to be the same. But what helps her right now, because she doesn't really like to budget, but all I'm asking her is to keep track of this $390 a week. That is her spendable. And so on her app, I'm just going to pull it up. This is what she sees. So on her phone, okay, there's an app for our cell phones. This is all she has to keep track of, right? So monthly found. And so my job is to help her allocate this to make sure that it's going towards her savings and investing goals, okay, her financial goals, right? So all of her stuff is, this is her snapshot, her income, her debts, okay, it's all laid out here, but all she has to do is focus on not spending more than $390 a week, okay? And so long as she doesn't go over this amount, all the money, okay, once I allocate this for her, the money found, that goes towards savings and her, let's just say her TFSA, okay, then that's it. She is definitely setting aside an additional $1,000 per month towards her savings and investments. Okay, so that's an extra $12,000 a year. Okay, it's a substantial amount of money. Okay, that can change. That's life changing. Okay, it's a big sum of money. So I could just leave it like that, right? And I can just tell her, I can just say, okay, allocate this amount towards whatever it is, and just focus on not spending $390 a week. But if she's like, no, I need to spend a little bit more, okay, cool, right? Remember, budgeting, managing your cash flow is about what makes you feel good, right? So if she's like, I want to spend a little bit more, maybe like $450 a week, then sure, because she told me she was spending $2,000, close to $2,000 a month. Cool, right? We'll make that adjustment. And what that ends up happening is she's going to be saving just about $800 a month towards her savings and investments, right? Because it's all about balance. So that can happen. So this can be adjusted and tweaked later on. But the key is knowing that there's an amount of money here that's not being accounted for. And so long as, I increase this amount in her plan, let's just say I'm going to put that all towards her TFSAs. Okay, then I just basically allocated her all her money towards her TFSA. And then now instead of saving $200 a month towards her TFSA, she's working towards maxing it out, and she's going to be putting a total of $1,000 per month towards her TFSA. Okay. So that's my job as a financial planner. And obviously it depends on her goals and what she wants to do, right? And then I can tell and I can show her where this, like what happens when allocating $1,000 a month will get her in like 20 years or 10 years, whatever it is that she needs that money for and when she needs it. Okay, so I could leave it like that. But let's just go back to, this base case right here, $390 a week. So there's $1,000-ish, almost $1,100 per month that's not accounted for. But my job is to also look at where else can I dig in to optimize her cash flow. So she has noted, she has shown me that she's got debt, right? She's spending a total of $981 on credit cards and a line of credit payments, okay, on top of a mortgage, okay? So Total monthly debt payments of $2,888. So she has a mortgage. Okay, interest rates are going up. These interest rates are pretty high. What can she do to bring down these monthly payments and to save on interest costs? So right now she is currently paying $2,888 in total debt payments. So what happens if she refinances? So let's just say she takes, so her current mortgage is $285,000 and she has all of these additional debts that she wants to get rid of because the interest rates are so high. Okay, so that's almost that's $65,000 worth of just like consumer debt. Okay, so she's going to take that and lump it into her mortgage. Okay, she's going to break her mortgage because her renewal it's not up yet. So to break a mortgage, the cost is 3 months worth of interest on the balance of the mortgage. Okay, so roughly $1,425. So what would her new mortgage payment be? Her new debt payment be if she were to take all of these debts, lump it into her mortgage, and refinance? So I'm going to use this calculator and unification. So her new debt payment, her new mortgage balance will be $352,000. Let's just say it's a 3% interest payment. I'm going to go update. So now her monthly debt payment is now $1,670, okay, as opposed to the $2,888. So if we go to opportunity, by refinancing, she just freed up an additional $1,100 of cash flow per month. Okay, remember this number was just under 1,100 before, but if she were to refinance, okay, her monthly debt payments will go from $2,888 to now $1,670. Okay, which adds another $1,100 to her monthly cash flow. Okay, so this is why, this is how refinancing your debt is very key to freeing up monthly cash flow, because one, she can use the extra money now, instead of going towards high interest cost loans, she can use the amount to pay off her mortgage more aggressively. Okay, the interest rate on her mortgage is substantially lower than on her credit cards. She can do that. She can, whatever she wants to do with now a total of $2,300 in freed up monthly cash. Okay, she can really aggressively top up her TFSA and start maxing that out. She can throw an extra $1,000 towards her principal, and maybe now she can put all that towards her TFSAs. Maybe she wants to top up her RSPs. There are a lot of things that one can do when they have more cash flow, right? So that's why it's really important to have a look at your cash flow. But also, if you have a bunch of debts that you need to get under control, and you're a homeowner, you have a mortgage, and you have the opportunity to refinance, really consider that. So if you want to set eyes on your finances, if you want me to help you build something like this, leave a comment below that says free my cash, and I will give this to you for free. Okay, so this is the first step I do with my VIP clients. As I explained earlier, why this is super important. So if you want something like this, I will happily do this for you to see how much money I can find for you, and if there are any opportunities for you to refinance any debts that you may have. So it's super important, especially at a time like this when interest costs are going up for everyone. So just leave a comment below, free my cash, and I will get back to you on that.